Hello, good morning. Welcome to Power Breakfast in the Mumbai News Centre. I am Anisha Jain and with me is Mangalam Malu. Well, Mangalam, good morning. We're starting off the day with a heady cocktail of cues, one which will give a lot of bad hangover to the bulls. The dollar index is above, the level 96, as well as crude above the 86 level. And even if you look at the US yields, that one are racing to the 8.2 level mark. So a lot of cues that we have to deal with this morning.
A lot of cues that we have to deal with, Anisha, and the SGX Nifty is indicating that it is sharply lower. We will talk about that, but there is a lot that we have to talk about today as well. Heady cocktail, as Anisha said. All right, the Asian markets, while they were mostly higher, they are off the high point of the day. So if you take a look at the Nikkei, that one opened with a sharp shade of green, however, has now moved into the red. The dollar yen has strengthened a little bit, but still above levels of 110 thereabouts seen in the previous month. Not doing too well for the Nikkei in the current trade. The emerging markets under a bit of pressure perhaps on account of the crude moving higher, dollar index at 96 as well. Meanwhile, in South Korea, however, the Kospi has slid about 1% on reports that the Bank of Korea Governor Lee Ju-yul has hinted at a possible rate hike later in October, so dampening sentiment out there as well. Remember, the Korean markets were shut in yesterday's trading session, so that exaggerated cut on account of a catch-up too. The Chinese market shut the trades down by about 1%. The SGX Nifty, that is the most important indicator for our markets today, down by almost 125 points, and that is following a sharp decline that we saw about 130 points from the high point of the day yesterday as well, and 10,758. Well, this could mean a start below that 200-day moving average for the Nifty. We have seen a sharp decline and perhaps levels may not matter. 125-point decline is what the SGX Nifty is indicating. Crude closer to $86 per barrel mark and the dollar index at 96. Let's see what happens.
Oh yes, because it is the second half of trade where all the action is. So let's see whether there's any buying that comes in the second half. But in the US markets, the Wall Street ended with modest gains on strong economic data. Now, September ISM non-manufacturing report beats expectation at 6.6 versus 58. Now remember, additionally, private payrolls increased by 230,000 in September, the most since February, according to a report from ADP and Moody's Analytics. The US 10-year yield rose to the highest level since 2011, while 30-year yield traded at levels not seen in 4 years. The Dow Jones, as a result, climbed around 54 points. It was hitting a record high earlier, though closed off the high point of the day. The S&P 500 was closed flat as losses in consumers as well as utility stocks actually outweighed gains that we saw in the financial sector, while the Nasdaq Composite rose by around 0.3%, led by gains in the stock of Apple. CNBC's Courtney Regan gets us a wrap of all the action on Wall Street.
The major indices did end the day higher, as you point out. The Dow closed at a fresh record high, marking the fifth straight day of gains, too. But the average, along with the Nasdaq and the S&P, closed off session highs as investors shifted their attention to higher yields. The yield on the 10-year Treasury note hitting the highest level since mid-2011. That's 7 years. And then yields on the 30-year bond reached a 4-year high. The 2-year yield saw the highest levels in a decade. Sectors were mixed, with the rising rates driving the outperformance in financials and the subsequent weakness in utilities. Higher oil prices did prop up the energy sector, actually the strongest sector of the session. And shares of Barnes & Noble jumping 21% after the market close on news that the bookseller is considering strategic alternatives following acquisition interest from multiple parties, including the company's chairman, Lynn Riggio. A special committee made up of board members is going to be leading the strategic review process, and Riggio will vote his shares in favor of any transaction the committee recommends. That's according to the retailer. Now, shares of GM did gain 2% today. The automaker teaming up with Honda to build an autonomous vehicle, and the Japanese automaker taking a 5.7% stake in GM's Cruise Holdings subsidiary, its self-driving car unit. General Motors saying that Honda's stake pushes Cruise's valuation to more than $14.5 billion, coming just months after SoftBank's Vision Fund invested in that unit. Now, the two automakers planning to develop a self-driving vehicle, which will be built in a GM plant.
Okay, so that was the action back on the US yesterday, but also listen in to some opinion from experts on the road ahead for the US markets.
The basic driver for US equities this year is earnings growth, because with the benefits of the fiscal reform, tax cuts are boosting EPS and with earnings per share, and with growth also stimulated by the tax cuts, the leverage effect onto earnings is considerable. So you're seeing earnings growth in the States for around 22% this year, not all of which is driven by tax. And then there's a follow-through into next year. So investors are at the time of the year when they start to think about 2019 earnings and the valuation that brings you in stocks, and I think they like what they see. But it is very much that earnings story that has made the US the preeminent equity story of 2018.
What is giving markets or investors comfort is the fact that, the Fed chairman has come out multiple times and said that, their inflation target is symmetric, right? Meaning that they will tolerate periods of strong inflation without being too aggressive in terms of rate hikes. And I think markets really like that. And if you, and then more to the point of equity volatility, I think a big driver of what is keeping volatility low is the breakdown sector correlation, sector dispersion, right? So we are getting volatility in the equity market. It's at the sector level, tech, financials, industrials, materials, but because they're moving in different directions, at the end of the day, S&P often ends up unchanged, right? So you get low index volatility, but high sector volatility. And that, to me, is constructive because it tells you people are differentiating between the big stories out there. What do you think?
All right, and Federal Reserve Chairman Jerome Powell in his recent comments seemed pretty upbeat about the U.S. economy. In an exclusive conversation with CNBC's Steve Sedgwick and Karen So, Charles Evans, the president and CEO of the Chicago Federal Reserve, shared similar viewpoint, expecting the economy to grow even higher next year. Here's an extract of that conversation.
I think neutral is just a little over 3%. The U.S. economy is doing extremely well. Fundamentals are very strong. The labor market is doing terrific. Unemployment is below 4%, which is really something. Payroll employment has been over 200,000 per month for many months, which is really, really a good showing. And inflation is up to 2%. I spent quite a long time indicating that I think inflation needs to get up to 2%. And here we are. So I think things are going very well. This is something that can be continued for a number of years. In fact, I think that by setting the policy rate just a little above neutral, that will continue to keep things going for quite some time.
I have, for 30 years, I used to be a trader, and like every other trader, I was obsessed by a non-farm payroll on the first Friday of every month. But the bit I really look forward to now looking at is the AHE line as well, the average hourly earnings as well, sir. Right. Any indication that the AHE is going to tip higher in a more aggressive fashion at any stage, or do you think that side of the equation is still very much under control?
Well, I think wages are a big part of the issue right now, and average hourly earnings is one part of it. The employment cost index is another piece. Every indication we can get as to whether or not labor is getting paid more in line with productivity growth and inflation, how is that supporting income and their demand? That's very important. We have gotten it up. It's at about 3% depending on your measure. That's stronger than it had been. But during much stronger times in the mid-2000s, we were in the 3 to 4% range. I would personally think that it would be a very good sign if we got up to that level. Some of the things working against that is productivity is lower. It's much lower now than it was during that period. And the puzzle, I would say, is you talk to so many businesses and they indicate how difficult it is to find qualified workers. They're looking for a slightly higher skill mix, I would say, than 10 years ago. And they're struggling to find the workers. Then you ask them, well, are you paying more? Well, that's not exactly our first choice. And they work very hard to find workers at the right wage, knowing that it influences their entire wage bill if they increase wages. And so they're struggling, and yet people are employed. Businesses are expanding. The economy is doing well. So one way or another, I think it's going to work out.
So, Charlie, just to be clear around trade then, because we've got negotiation that's happened around NAFTA, the new NAFTA deal, Canada, Mexico, United States. But still open question is what happens with China, and the tariffs have come into force, and economists are telling us you'll start to see the impact on prices potentially around about November. Can you look through an increase in prices if it drives up inflation?
So that's always an important part of the art of central banking, is to try to infer true inflationary movements. Movements in prices that lead to higher inflation, and higher inflation expectations are particularly worrisome if they're above your objective. Changes in relative prices, though, can find their way into the price index for temporary period of time, and then they work their way out as relative prices adjust, and then the new levels go on at the 2% inflation target. So we would need to look at that. One way that relative price movements like trade shocks would find their way into inflation is if the central bank accommodated inappropriately those types of movements. So if they're transitory, we can look through it. We don't have to make a big movement. But if they are repeated and continue to be something, we might have to look at that. But I'm not really concerned about that over the next couple of years.
All right, that's as far as the Fed's trajectory is concerned. But across the Atlantic in Europe, too, markets, they posted a solid gain as far as the FTSE and the CAC is concerned. Remember, yesterday, the German index was shut. The players kept a close eye on Italian politics and shrugged off concerns surrounding global trade. The UK FTSE and the French CAC ended almost 0.5% higher. Meanwhile, the Italian index, which underperformed in the previous trading session, that index rallied. The markets rallied almost 1% after populist coalition government said that it will cut its budget deficit targets. The previous session, there were concerns over the fiscal deficit as well as the budget concerns, and there we saw underperformance come by from there. But the action happened in the emerging market space, specifically in the Brazilian index, which clocked gains of 3.8% in the previous session, topped that with another 2% gains. In Brazil, what did well was real estate, financials, as well as public utilities and politics. Sentiment is changing in Brazil. The far-right candidate, Jair Bolsonaro, presidential candidate, is gaining popularity. Why is that? Well, because there is some sort of anti-incumbency out there. The only option to prevent the return of the leftist Workers' Party, who've been ruling Brazil for 13 out of the last 15 years, and they have been, blamed for crippling recession out there, some corruption as well. So anti-incumbency, gaining popularity of a far-right candidate, adding some sentiment to the Brazilian index, which just a couple of months ago was trading around that 69,000 mark, currently at 83,273 as we speak.
Okay, so that was the action from the equities market, but a lot is happening in the world of currency as well, because the US dollar gained as strong ISM manufacturing data and ADP jobs reports supported the view that the US economy is in strong shape. Meanwhile, concerns about at least budget negotiations continue to weigh on the euro, the dollar index currently hovering above the 96 level.
The world of commodities, crude oil hovers around $86 a barrel mark as upcoming US sanctions on Iran remain the key focus for the markets. Surprise build in US crude stockpiles and reports of higher Saudi Arabian and Russian production also led to oil rising to a fresh 4-year high. Yesterday, back home on the Lal Street, almost all indices ended with deep cuts following a major sell-off in the last hour. The Nifty breached the 10,850 mark, while the Sensex 2 ended below that 36,000 mark. Among the broader markets, the Nifty Bank and mid-caps fell more than 1%, managed to hold on to the 25,000 and 17,000 mark respectively. However, the market for today's trading session does not indicate a good opening, especially given where crude is, and the SGX Nifty at the low point of the day, 10,768. Ekta joins us this morning. Ekta, not good in terms of cues.
Yes, absolutely. Well, I'll just recap what took place in yesterday's trading session. The Nifty, like you mentioned, saw selling in the last hour of trade. The rupee closed at a record low of 73.34 versus 72.91 on a day-on-day basis, and the 10-year yield closed above 8% at 8.11%. The FII's net sold 1,550 odd crores in yesterday's trading session, and the DII's net bought around 1,402 odd crores. Now, you know, after the markets closed, we did get a booster shot from the RBI, where they liberalized rules for the public sector OMCs to borrow overseas in order to actually boost the markets and to help aid the rupee. But overnight, actually, things have changed quite dramatically. You guys have been talking about the US markets, and that would be the primary reason why we could see selling pressure today. We have the dollar index, which is at fresh highs at around 96.08. We have the US 10-year, which has climbed to multi-year highs for the US 10-year as well as the 30-year yield. So all of the US data, which you guys have been alluding to, was extremely positive, pointing to a strong US economy, and the macros or the dollar index is indicative of that kind of strength. The US markets themselves did not end, were a little perturbed. There were record highs for the US markets, but they were overall a little perturbed. So these two primary indicators, which is the US 10-year as well as the dollar index, will really determine moves for us, along with Brent crude, which is now almost $86 per barrel. 85.93 is where Brent crude was the last time I saw it. So 85.95 is currently where Brent crude is. So this combination is going to result in weakness for us. So the SGX is indicative of that. The SGX is indicative of the fact that it's going to be a downtick this morning of around 1% and most of Asia is weak as well. Barring a couple of markets, we have most of the Asian markets which are trading with a downtick of around 1% at this point in time. So overall, what the RBI has done will largely get negated by what exactly is, what exactly the global markets are throwing up. And in terms of what we would watch in terms of key levels, the recent low on the Nifty was 10,821, which we hit on Monday itself, and the 200-day moving average of 10,774 is what we'd be watching out for. It is Bank Nifty options expiry also today, so there could be some amount of movement on the Nifty Bank with regards to that.
Okay, so it looks like it'll be a difficult morning for the bulls. A lot of macro cues to track. But Ekta, what are the stocks that you're watching out for?
Well, also the RBI policy meet begins today, so that would be another key factor, and maybe the rate sensitives would be in focus on account of that. New ILNFS board is likely to meet in Mumbai today, so a lot of those ILNFS stocks would be in focus. Separately, the RBI has imposed a monetary penalty of around 5 crores on Federal Bank. HDFC has disclosed ahead of Q2 that they've earned around 787 crores from HDFC AMC IPO. And they always do these disclosures before their Q2 numbers, so that's in line with that. BSE says they've entered into a licensing pact with London Metal Exchange. ILNFS Transport Networks has separately mentioned the interest due and payable on October 1st on some NCDs weren't paid. Failure to pay debenture holders due to insufficient funds. These are just a couple of stocks which will be in news, but there will be a lot of focus in terms of all of the companies that would be impacted due to higher crude prices also.
Well, with the rupee testing new historic lows, the RBI has stepped in. Now, the central bank has liberalized rules for oil companies to borrow from abroad. The move is expected to ease borrowing costs for OMCs. Now, we spoke to M.K. Surana of HPCL and former ONGC chairman, Mr. R.S. Sharma. Here are what they had to say.
New circular allows it to be taken from more than allowed sources earlier and without a mandatory hedging requirement. So the companies will have more flexibility to decide their own strategy for the risk mitigation and certain natural hedges which they may have and the timing of taking the hedges. And to that extent, the companies will have more flexibility to manage their foreign currency requirements. It should help in reducing the hedging costs also, because when you are borrowing for a longer term dollar, the pressure on the immediate basis to hedge will not be there.
There is a lot of pressure on the rupee in terms of exchange rate, and these oil marketing companies are the heaviest purchasers of the foreign exchange for their crude oil payments. When they are able to borrow overseas, they will not be required to buy dollars in India to that extent, and they'll be able to use those funds, overseas borrowing funds, to pay for their oil imports. This is what I understand. This is a way it will ease a lot of pressure on the exchange rate.
All right, let's keep it with the rupee's fall itself. Commerce Minister Suresh Prabhu too is expected to chair a meeting today to take stock of the pressure on the currency and the trade deficit picture. Sources say officials from the finance, petroleum, coal and pharmas as well as steel ministries may attend this meeting. Rituparna Bhuya, our colleague, is here with the details on what is on the agenda for this meeting.
Ministries and departments which will be attending this meeting include Department of Economic Affairs, Coal Ministry, Steel Ministry, DIPP, Ministry of Heavy Industries, Pharma Ministry, basically line ministries which are responsible for goods and commodities which constitute a large portion of our import basket. The idea is to understand the kind of import trends that will be seen going forward and the kind of impact that will have on rupee and also the exchange rate. Now, this meeting comes days after a similar meeting, interministerial meeting, was convened by Suresh Prabhu on exports, where it was decided that the ministry will focus on 9 specific sectors to boost exports, which includes gems and jewelry, leather, textiles, engineering, electronics, chemicals, pharma, agri-products and marine products. So now we'll have to wait and see what comes out of this meeting, which is being chaired by Suresh Prabhu, and will there be any policy measures which will be announced after this meeting. With that, it's back to you.
Okay, important to track that meet for today, but it's time now for a quick break. Come back, we'll discuss more on the rupee and the fact that the new board of ILFS is meeting today.